assistants at the University of Central Florida for commercial real estate finance. In this exercise, we are asked to evaluate a property which was acquired on April 12th of a year with $1.5 million in cash and $4.5 million in debt. The mortgage was a 25-year fully amortizing at 4.25% fixed rate. There are no loan fees because the owner accepted a higher interest rate. The owner did not make any capital improvements to the property during the holding period. Year one NOI is given to us at $357,365. The property was sold on April 11th of the 8th year for $7.8 million with closing costs of 4.25%. The owner's tax rate, 39% ordinary income and 27% depreciation recapture and 20% capital gains. For this exercise, the debt retirement calculations is assumed 4 years, ignoring the month specified above to do the debt retirement calculation. The tax assessment for the property is as follows: 22% land and 78% improvement, totaling $6,092,700 total. We're asked to answer the following questions. What is the monthly mortgage payment? What is the mortgage balance at disposition? What is the first year before tax cash flow and the after tax cash flow? What are the sales proceeds before tax, the ordinary income due at sales, the basis for this property at acquisition, and the annual depreciation full year, and so forth and so on. So lots of things to get through in this problem. And so I'm going to ask you to take a minute to actually complete your spreadsheet. I always ask that you take a minute, and if you want to pause the video to create a worksheet that looks similar to what I have here, and you will want to put in all the inputs. The items that you see in gray or information given to us. For example, the cash to acquire the property, the debt that the owners are getting to acquire the property, the tax rates, the loan information, the NOI, the tax value, as well as the depreciation schedule, the property being purchased on mid-April, and being sold on mid-April of year 8. So all of this information was given to us. If you take a minute to complete this spreadsheet, what we're going to be asked to do is to calculate all of the missing information so we can answer the questions that you have in the bottom here. All of these questions will be answered in the next 20 to 30 minutes if you follow the instructions. I've even gone a step further because this problem is quite complicated. If you've been watching my videos in the past, so you should be familiar with how to calculate or do a cash flow, debt cash flow until you get to the before tax cash flow. And I put highlighted this row here, indicating this is where we're going to stop, or where we stopped last time, and kind of walking you through the numbers you see here are numbers where I'm going to systematically go through each of them in a particular order in terms of which item you should complete first, second, third, and so forth, to keep this organized. Otherwise, this can be quite complicated. It took me a couple times to go through this to fully understand which one I should be doing first, even when I was learning this a couple years ago. So here we go. The first step is to calculate the total investment for this retail project. All you need to do here is sum up the cash and the debt, so you can see the total purchase price, if you will, for this project. And so you get $6,092,700. And we're going to calculate now the loan information. It's easy to calculate the monthly loan payment. We simply use our payment function, which is the rate divided by 12. And then we have the term times 12. And then you have the present value, which is the debt. And then the future value is, hopefully at the end, will not owe any money. So your debt your monthly payment rather is $24,449. To calculate the annual payment, is you simply multiply this times 12, and you should get $293,000. The NOI was given to us as the net operating income for the first year was given to us. And so since we have the debt service, we just simply need to move the debt service from up here to down here. We're going to say equal the annual debt service. And then the before tax cash flow is simply the sum of the NOI and the annual debt. So, oops, sorry. The sum of the NOI and the debt should get, okay. All right, should be $63,000 for the before tax cash flow. I would recommend that you stop here and follow along where I have these numbers here to indicate which step of the problem you should complete first, second, third, and fourth, and so on. The first step I would recommend that you complete is the mortgage interest. The mortgage interest is a very lengthy function, which is the cumulative I payment. Cumulative I payment. Excel does a very good job at kind of walking you through some of the functions, and it's kind of telling us what we should be doing here. And it's similar to the payment. It's telling us that we need to get the rate divided by 12, and then the number of periods times 12, and then it's asking us to get the present value, which is the loan amount, and then we comma, and then it's asking us for the start period. The start period is just basically the first year, and then we're going to asking us for the end period. It is going to be same thing times 12. So we're going to do that, and we should be able to get, and then the type is 0. So our mortgage interest payment should be $189,800. That is the cumulative mortgage payment that we will be paying for this project or property. The NOI, we're going to move the NOI down from up here, which was given to us, and that is $357,365. The depreciation. Now, if you notice that I said don't work on this first, you want to go to step 2. To calculate it, you're going to do the tax value table first in order to get the depreciation. To get the tax value, we're going to first need to, the total for this property, we're going to bring that down, which is the $6 million. Going to bring that down, and the total for the total should sum up to 100%, the land and the improvement. And now we just want to calculate what is 22% of $6 million. We're just going to go equal 22% times the 6 million, and we should have 1.3 million. We're going to do the same thing for improvement. We're going to say what is 78% of the 6 million, and you should have 4.7 million. When you get that information, now it's asking what is the depreciation. As you know, you cannot depreciate land. So we're going to depreciate only the improvement. And to do so, you're going to do this formula here. It's going to be the improvement amount divided by its 39 years. As you know, commercial is depreciated over 39 years. So the annual depreciation for the improvements that were done for this retail commercial building is $121,000. After completing that, I'm going to go with, we're going to go ahead and complete the depreciation schedule, which is this section here. I put the note here. That's the fifth step of the process. And to do that, we're going to need to calculate the first year depreciation amount. And it is going to be the annual depreciation divided by 12. And we're going to multiply it by the 8.5 months. So we should get $86,000 for the first year depreciation. For the years 2 through 7, they're going to be depreciated for the entire period. So you can simply drag across to all the years. And to calculate the depreciation for years 2 through 7, we're going to simply it's going to be equal to the annual depreciation, which we already calculated. And to lock that in, we're just going to anchor that so we can drag it across like so. So we have the depreciation for all the years, with the exception of year 8, which we have to treat very similar to how we treated year 1 because it is a partial year. To do so, we're going to do the annual depreciation divided by 12 months times how many months that they're going to hold the property for year 8, and that is 3.5 months. So we should have $35,541. And the cumulative depreciation is going for year 1, it's going to be 86,000. For years 2 through year 8, it's going to be the previous year plus the current year. So this formula is going to be very simple. We're going to do the previous year plus the current year, and we're not going to anchor that because we're going to drag it across to calculate the total cumulative depreciation as we go from years 1 to year 2. So all we're doing here is we're adding the previous year's depreciation, the current year depreciation, to get the cumulative depreciation all the way to year 8. So now that we completed step 5, we should be able to complete step 6. Now it's asking us for the depreciation for year 1. The depreciation for year 1 is going to be the cumulative depreciation for year 1, and we're going to make that a negative number. We're going to make it a negative number because it is depreciation. So we have $86,300 for year 1 depreciation. The taxable income is going to be the sum of the NOI, the mortgage, and the depreciation. So we have $81,000. The tax liability is going to be I think they're taxed at 39%. Is going to be the taxable incomes times the ordinary tax rate for that investor, which is $31,000. So we've completed steps 1 through 8 in just a few minutes. We're going to go ahead and move over to step number 9, which is, well, first of all, step number 8, we completed it here, taxable liability. We have to bring it up here to continue the annual cash flow for this property. So step number 8, we complete that already. It's here. And we have the tax liability is $31,000. The after-tax cash flow then is going to be the sum. We're going to bring the tax liability as a negative number. Okay, and so the annual tax cash flow is going annual tax cash flow, after tax cash flow, I'm sorry, is going to be the sum of the before tax cash flow and the tax liability, which you get $32,000. That is our after-tax cash flow for this property, and we've completed step 9. We're going to move over to step number 10 to calculate the selling cost. Since we already know that the property is selling for $7.8 million at a selling cost at 4.25%, we're going to multiply 4.25 times the selling price, but we're going to make that a negative number since it is a cost, and we're going to do it like this. So the selling cost for that property at year 8 is $331,000. The debt retirement, we've been doing the function for quite some time, but it is a very lengthy function. So I'm going to slow down. If you want to pause the video to calculate your debt retirement after 8 years, it's going to be the actual debt amount minus cumulative rent, which is cumulative principal, and we're going to calculate the rate, which is, I believe, was 4.25 divided by 12, and then the term times 12, and then we're going to put in the present value again, which is the debt amount, and it is asking us for the start period, which is 1, and the end period, which is 8 years, but we're going to multiply that by 12, and we're going to put in comma 0 to end our function. So the debt retirement after 8 years, if you want me to highlight this again, I will double click on it so you can see my formula. It's a very lengthy formula, but it's quite simple. If you follow the Excel instructions and the guide that Excel gives you, you should get $3.5 million. The net value then is a sum of the price and the selling cost and the debt retirement. So the net value for this property is 3.9 million. You're going to need that to calculate the sales proceeds after tax. This is the sales proceeds before tax, and we're going to be calculating the sales proceeds after tax. The sales proceeds after tax is going to be asking us for the net value, which is the net values we've already calculated that. There's no ordinary tax. The depreciation tax is going to be what are we paying for tax for calculate your net value, and you bring your net value over here to the sales proceeds after tax. You really want to calculate the gain on sale before you calculate the sales proceeds after tax. To do so, it's fairly simple if you follow along. The sales price for at year 8 was already given to us. That is 7.8 million. So you bring that number down. The closing cost is 4.25% of the actual sales price, which is B34. So you should have, should be equal this times the closing costs, but you want to make that a negative number since it is an expense. Should have $331,000 for closing costs. The adjusted basis is the negative of the initial investment, which is the $6,092,000 minus the year 8 depreciable amount, cumulative depreciation rather, should have negative $5 million. And I like to keep them consistent. So negative $5 million, $5.2 million to be more specific. And so the gain is a sum of the sale price, the closing cost, and the adjusted basis. The gain should be 2.2 million, and the depreciation taken is simply the cumulative depreciation for all years that you held the property, but that needs to be a negative number because it is a money out of your pocket. And I'm going to keep everything consistent and make sure it is in red. The taxable gain is the sum. Taxable gain is the sum of the gain and the depreciation taken, and you should have $1.3 million. The capital gains tax is the taxable gain times the capital gains tax. We get that way up here is 20%, and that should be a negative number because it is an expense. So your capital gains tax is $275,000. Now to continue on to wrap up and complete this problem, the sales proceeds after tax, there's no ordinary tax. The depreciation tax is going to be the negative amount of the depreciation, the total depreciation for all the years, times the depreciation tax, which is 27%. We should have negative $230,000. We've already calculated the capital gains tax. It is right here. We're going to bring that number over. It is here. We're going to bring that number over, $275,000. And so the sales proceeds after tax is the sum of net value and the depreciation tax and the capital gains tax. You should have $3.4 million. So to answer all of the questions that were asked of us, number one is the monthly mortgage payment. That is up here. Monthly mortgage payment is here. The what is the mortgage balance at disposition? The mortgage balance at disposition is when we calculated the debt retirement, which is the 3.5 million. What are the first year before tax cash flow and after tax cash flow? We have those up here. We have the before tax cash flow and the after tax cash flow consecutively. We're asked to calculate the sales proceeds before tax. The sales proceeds before tax was $3.9 million, which is the sales proceeds before tax. And we didn't have any ordinary tax due at sale. The basis for the property was calculated here at $6 million. $6 million. And then we were asked to calculate the annual depreciation for the for any full year. We calculated that up here. There was an annual depreciation for each year, the full year. We were asked to calculate the first year depreciation. That is simply a prorated amount for the annual depreciation because the first year we had the property for 8.5 months. So the prorated amount would be $86,000. We were asked to calculate the depreciation recapture. We calculated that and we got $852,000 for the cumulative depreciation recapture. We're asked to calculate the depreciation recapture tax due, which was $230,000. We did that here. We were asked to calculate the gain on sale. The gain on sale, we were making $2.2 million, and that is the gain on sale here. We were asked to calculate the capital gain amount, which was $1.3 million. We were asked to calculate the capital gains tax rate, which was at 18% tax rate, was $247,000. And last but not least, we were asked to calculate what is the sales proceeds after tax. The sales proceeds after tax for this project, for this property, would be $3.4 million, which was calculated right here, and cell number G37. I hope this was informative to you. If you have any questions, please feel free to comment in the video. Until next time, take care.